The recognition of provisions in the initial period is often not that problematic, but understanding how it unfolds over the longer term does require a little bit of thought. So let's think about this with a simple example. We're going to talk initially about the recognition of a provision in year one, and we'll assume that this is an event which is going, or occurrence which is going to have cash flow implications for the next 10 years, and I've outlined these cash flows in the table that you can see. Most of the cash flows are loaded towards the front end. They total $55,000, and if we have an interest rate of 8%, the present value of those future cash flows would be $41,124. So assuming this is a provision which arises from something which has happened in the current period, we'd have to recognise an expense and a liability for the provision. So you can see here warranty expenses $41,124 and provision for warranty, a liability $41,124. Where it becomes more problematic is what happens in subsequent years. Because if we think about this, the provision that we have to recognise in subsequent years is going to change because, one, we've made some cash flows, probably some payments in the first year, and two, the amount that we expect to pay might change. And so the question is, how do we recognise this change in the provision from one year to the next? Probably the best way of thinking about this is to understand what are, say, the implications of the net present value calculation, and then to reflect upon how that impacts the accounting. Probably the best way of thinking about this is to think about how the numbers have changed. If we think about the balance that we had recognised in the first year, $41,124, it's actually going to increase if nothing else changes over the next year, simply because of interest accruing. And if we discount those cash flows for a lesser period, they'd be worth more, wouldn't they? So maybe the first thing we need to understand about the change in the provision is that it's going to go up by the implicit interest rate. So in this case, $41,124 at 8% is $3,290. And that is like a financing charge, because if nothing else happened, our provision would go up by that amount. Our provision is also going to go down between period 1 and period 2 because we made some payments, $10,000. And you can see that if nothing else changed other than we made the payments, the interest rate stayed the same, and our cash flow expectations stayed the same, then our liability at the end of year 1, beginning of year 2, would be $34,412. However, there are going to be other reasons why it's going to change. Maybe we'll have different expectations as to the cash flows we're going to have to pay, and maybe the interest rate will change. And so we need to recognise that part of the change in the provision as an expense in the current period. It's an expense which might be a positive or a negative number if, as occurs in this case, you can see that the cash flows are going down, so quite obviously that's going to reduce the provision that we have to recognise. So just to reconcile things, please note that we have $41,000 recognised in the first period. It's going to go up because of interest, which is payable, and it's going to come down because of the amounts that were paid, and we're going to have to recognise any change in the provision as an expense or a benefit in the current period. So what does that look like in terms of the accounting? Well, what we can see here is that we'd recognise an interest expense, $33,290. Would recognise the payment, the $10,000, and would recognise the change in